In this week's video, we'll review the latest charts and data to help us answer the question, did the Fed just trigger a major shift in market leadership? We'll be moving quickly, so feel free to use the pause button on your video player. We'll start with the leadership question and conclude with a detailed update on long-term market trends. The correction charts and the inflation-related charts that we've covered in recent videos were incredibly helpful this week. They told us to try to remain patient heading into the Fed meeting, and that turned out to be a good move. Via Wednesday's announcement and press conference, the Fed signaled to the market that it still sees 3 interest rate cuts between now and the end of the year. Thus, it's possible that event could trigger some shifts in leadership, especially from a short to intermediate term perspective, several weeks, several months. Year-to-date, laggards, IWM, small caps, up less than 4% as of Thursday's close. RSP, the equal weight S&P 500, doing a little bit better, up 6.73%. Regional banks down 4.76%. All three of them lagging SPY, up 10.21% year-to-date, again as of Thursday's close on March 21st. The first chart's going to incorporate BSCO. It's an investment-grade corporate bond ETF with very short maturities. So the ratio is BSCO divided by RSP, the equal weight S&P 500 ETF. And we could have used any number of short-term bond ETFs to illustrate the same concepts. BSCO relative to the equal weight S&P 500, calendar year 2017, 2018, 2019, and 2020. To set the stage here, this is the COVID plunge in the S&P 500 down here. So this is what risk off looks like using this ratio. If you think the world's going to end, you'd rather own very short-term corporate bonds relative to the equal weight S&P 500. Conversely, when the tolerance for risk increases, as it did after the COVID low here in Q4 of 2020, most likely you would rather own RSP over short-term corporate bonds. So the ratio was consolidating for the most part in 2018, 2019, and 2020. It held here, it broke support here. And you can see after that, really good things happened in the S&P 500. It had a very strong trend for almost a year, relatively muted drawdown here, and then it carried into early January 2022. And if you look at this breakdown point here and you look at the relative performance of ETFs, from this point here, after this breakdown, when the S&P 500 starts to move in this direction in a very consistent manner, small caps outperform and semiconductors outperform significantly. And clients and longtime viewers of these videos know we've looked at small caps numerous times in recent weeks and months and really haven't been all that impressed, especially on a relative basis. And that's not surprising when it's lagging this significantly year to date. But that may be getting ready to change. We have a similar setup here. The ratio held here, it held here, it held here, it held here, it held here, and it recently held here at the end of 2023. But this looks different. Now we've exceeded and broke below this low here, and you can make an argument it's possible that this point here is similar to this risk-on point here. This breakdown here kicked off a very short-term window of about 5 months where small caps significantly outperformed. And this breakdown occurs here roughly the 3rd week of November in calendar year 2020. So let's look at that exact same point, the 3rd week in November of 2020, and see what the ratio of small caps IWM looked like relative to XLK, the tech sector ETF in the S&P 500 index, and a long-term market leader. Right off the bat, there are some differences. Because when this breakdown occurs here, the 3rd week of November in 2020, that's right here, this ratio has already been making a short-term, several-week series of higher highs and higher lows in here. If we drew a line here from here to here to here to here, it's really better than what we have in here. Now, having said that, there are some similarities. The ratio is moving sideways in here. It's moving sideways in here. It's not that far from the declining 250-day moving average in black. Not that far from a declining 250-day moving average in black. Moral of the story here is, if small caps are going to outperform, and they're going to outperform significantly, this ratio really has to start to take on a look more like this. So let's zoom in. Let's compare this window here to this window in the present day using the same moving averages, 20-day all the way out to the 250. And remember this reference point here, the third week in November of 2020. That's relevant because that's where that breakdown occurred in the ratio, and we have a very similar look on March 21st of 2024. So when that breakdown occurred, look how close the ratio of small caps to XLK is to the 250-day moving average. Compare and contrast that with where we are on March 21st at the close. Thus, if you're a small cap bull, you would like to see the present day ratio in the lower right-hand corner of your screen start to morph into something more like this. And that can happen very, very quickly. There's not a lot going on in here, and then things start to change rapidly. So this point right here in early November is this point right here. And after that, small caps outperform significantly for several months. This is November of 2020. Also keep in mind, you can see it here. In early November, look at the slope of the ratio. It's in a better spot than we are today. This ratio has really gone nowhere. We can draw a horizontal line going back to November of last year. So if we're going to allocate some of our resources to small caps, and we're more than open to doing that, we need to see something like this. And that may start to happen on Friday. Really haven't seen a lot as of Thursday's close, and this is after the Fed meeting. Fed meeting was Wednesday of this week. This is Thursday's close. Similar situation here, but now we're looking at a weekly chart, and we're looking at small caps relative to SPY, the S&P 500 ETF. Again, here's your third week of November 2020. This is that window where small caps outperform for a relatively short period of time, but they outperform in a significant manner. So once again, this really doesn't look like this yet, but that could happen again very, very quickly. Notice price gets above all of the moving averages. Blue starts to turn up. It crosses above red. Green starts to flatten out. Don't really have any of that just yet. This move from here to here, let's say maybe that took a month to 6 weeks. So this is what we'd be looking for relative to price action in the moving averages. How about momentum? If we had some indicators, Williams percent R weekly, this is what it looks like, the early stages of the outperformance. This is what it looks like on March 21st at the close. TSI, early in the move, weekly TSI, black clears the center line. We're close to the center line, but we haven't done that yet. Weekly RSI, early in the move, down here, starts to move away from the center line, or 50, and starts to move towards 70. So this doesn't really look discernibly different from this in here. So if you're a small cap bull, you want this, this, and this to look more like this, this, and this. This is a what to look for chart, and we don't have it yet. Why is the relative performance important? Because we're fully invested for the most part, and if we're going to allocate some resources to small caps, we would want it to outperform. We would want it to have a high probability of outperforming. And our time frame is very long term, so even if good things happen, this is a 5-month sharp counter trend rally where small caps outperform, and then the primary downtrend resumes. If you bought small caps here and held it all the way into here, you were at break even. Down here in 2023, it hurt you rather than helped you. So even if we see this, 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 and this, we would be allocating a very small portion of our accounts to small caps. And then we'll see how it goes. If it continues to outperform and it warrants a larger allocation, happy to do it. Very similar concepts here. Third week of November, this is what small caps relative to the equal weight S&P 500 looked like. In November, you have almost a full bore bullish look with blue, the fastest moving average, on top, and black trying to turn up. So let's say this is maybe a 65% full bore bullish look. We don't really have that here, but we do have a very tight cluster look. Whereas if we jumped out here in a very violent manner and these moving averages started to turn up, somewhat similar to this cluster here, that would be a positive development. And you can see things can move rapidly. This is during Thursday's session. It just hasn't happened yet. Very similar concepts. Again, a daily chart here, 20-day out to the 250-day in black. By the third week in November, this ratio looked a lot better than it does today. And why is that relevant? Because the third week in November, with this look here that looks better than what we have today, is when this bearish breakdown occurred that we opened the video with. This looks similar to this, telling us to be open to the rally broadening out. It's probably fair to say the probability of small caps making an outperformance run here is probably greater today than it was just a few days ago. Having said all of that, this looked like a better setup over here than what we have today. If we look at a daily chart of small caps divided by XLK, the tech sector, similar concepts. Third week of November, when that bearish breakdown happened on the first chart with BSCO, the ratio was up near the 250-day moving average. Not quite in that range yet. Everything that we've said about the previous charts applies here. In the third week in November, this looks better than what we have today, telling us to be patient. If something like this is going to happen, this has to change. Small caps are going to outperform at a minimum. That implies outperforming SPY, so we would have to take on a look like this. Right now, this ratio is still hovering somewhere around a 52-week low, which was not the case here. You are well off a 52-week low when this happens in the third week of November. Very similar concepts. Third week of November, RSP divided by VU. Because remember, we kicked off the video with this concept. When this bearish breakdown happened, the rally did broaden out. RSP, IWM, small caps started to outperform. Again, this is similar to March 21st, 2024. But when that breakdown occurred, this ratio was in a better spot than it is today. Here's where we are. Here's the 250-day. Here's the 250-day here. Price is above it. The ratio is above it by the third week of November. We're not using these charts to forecast. This is what we have in front of us. This is the chart in front of us. And this is what we would like to see to become more constructive on RSP relative to VU. RSP, IWM, small caps, KRE, regional banks, they've all underperformed significantly year to date. So being patient has paid off. We don't want to extrapolate that underperformance walking forward. We'll see how it unfolds. The Nasdaq Composite makes its final bear market low on December 28th, 2022. Just 4 trading days later, January 4th, 2023, we noted via this tweet that the market's character had changed noticeably and in a positive manner. We chatted with David Keller on the final bar in April of 2023, and this is the exact chart that we covered. It was dated April 10th, 2023. The chart was used to illustrate concepts that we had covered numerous times in our weekly videos. And that was that price action in 2023 was starting to distance itself from the failed bear market looks that we had in the dot-com bust bear market here and the financial crisis bear market here. We get a rally attempt here, but eventually it fails near the 200-week moving average in red. We get a rally attempt, big bounce here into May of 2008. That turns out to be a failed bear market rally, and price eventually slashes through a flattish-looking 200-week moving average here. That's not what we had in April of 2023. It's a much more constructive look in its present form, and momentum in April of 2023 as measured by weekly TSI here, was doing something very important. It was recapturing the center line. The market was unable to do that during the failed bear market rally and the dot-com bust bear market here, and also was unable to do it during the failed bear market rally in 2008 here. Simply telling us to keep an open mind about better than expected longer-term outcomes. Between January 2023 and April 10th, 2023, you may remember we had a very strong and much higher than expected monthly labor report in early February, and the market did show some weakness. But eventually, the longer-term trend came into play again, and the bullish picture really started to come together on multiple time frames in mid-May of 2023, prompting the series of articles shown on your screen. And all of this is relevant, including the June 16, 2023 video that talked about the secular trend, because it provides context. And keep in mind that April 2023 chart spoke to longer-term trends. And that's helpful because when the market inevitably pulls back, as it did in August of 2023, the longer-term trends in the bigger picture can prevent us from becoming too bearish. Short takes post dated August 2nd, 2023, as the market began to pull back. The August 4th video covered signals that again told us even if things get dicey in the coming weeks and months, that won't necessarily negate the longer-term setups that we've already seen and covered. And hence, even though the market had already started to pull back in early August 2023, we talked about favorable long-term opportunities using the slide on your screen. And there's a reason why we repeat often in these videos that secular does not mean easy. We have to have realistic expectations about 100% normal and to be expected volatility that occurs within the context of even the strongest trends. And that came into play between early August and October of 2023. The S&P 500 had a 10% correction. And by mid-November, momentum started to shift back in the bull's favor. And when this happens in November of 2023, the bigger picture context becomes very, very helpful at that time. The improvement in momentum from November carried into December of 2023 and eventually triggered numerous signals, including a signal that we covered on the NASDAQ 100, based on this rare A to B move, chart dated December 21st, 2023, covered in the December 22nd, 2023 video. From a historical perspective at that time, it told us to keep an open mind about much better than expected outcomes in the NASDAQ 100 looking out 1 to 5 years. All of this is relevant because it reinforces the concept that longer-term trends are extremely important, especially within the context of shorter-term volatility. Even though the market had a positive reaction to the Fed this week, we all know with 100% certainty at some point the market will pull back or correct. And just as this April 10th, 2023 chart was helpful, it's helpful to review big picture concepts from 30,000 feet when things are going well. Thus, in this segment, we'll update these longer term concepts using very similar concepts to those covered on the final bar in April of 2023. It's a monthly chart. These are monthly moving averages here. There's nothing magical about them. This is the Chande trend meter that we talked about in June of 2023 in that secular trend video. And ultimately, between 1951 and 1968, a secular bull market, this is pattern recognition. From a price action perspective, the market tends to make a stand at or near the upward sloping moving averages, and it does so several times between point A and point B. Similar situation down here with the trend meter. It tends to stay in a consistent range, holding here in 1953, in a similar area in 1957, 1962, and 1966. In each one of these cases corresponded with an important low in the stock market. And all of this is helpful from a risk management and asset allocation perspective because at some point the pattern will be broken, as it was here in 1969. Look at price action here in 1969 using the exact same monthly moving averages and contrast it with price action during the secular trend. This looks significantly different from 1969, 1973, and 1977. The same can be said for the nice clean pattern that we had in the Chandé trend meter down here on the monthly chart during the secular trend. Rather than holding at these levels in late 1969, early 1970, the pattern was broken in a decisive manner. This, and this look discernibly different relative to the pattern on your screen. Notice the trend meter gets into the yellow range here and holds. Yellow and holds, yellow and holds. And for the most part, never even hits the midpoint of that range. Not the case here, not the case here. And there's even information here. Price action is relatively weak, but it's fair to say, as this period of secular stagnation is nearing its end, trend meter over here starting to look a little bit more like these holding periods here in 1953, 1957, 1962, and 1966. Easier markets are often followed by harder markets, and harder markets are often followed by easier markets. And it's probably fair to say the secular trend window between 1982 and the year 2000 looks very, very similar to the secular trend window shown on your screen between 1951 and 1968. And the 82 to 2000 secular trend really doesn't look anything like the period of secular stagnation between late 1968 and into 1978. And at some point, the market needs to consolidate its gains, and we know that easier markets tend to be followed by harder markets. And just as price action looked discernibly different near the moving averages between 1969 and 1977, the pattern that we had in the 1950s and 1960s, and the pattern that we had in the 1982 to 2000 window was not in play during the dot-com bust bear market here, and was not in play during the financial crisis bear market here. The same can be said for the trend meter. 1950s and 1960s, 1980s, 1990s look discernibly different from the trend meter in early 2001 and early 2008. And it's noteworthy, the stock market doesn't bottom until October of 2002. Stock market doesn't bottom until March of 2009. And between this point here, which is here in terms of price action, and this point here, really bad things happen. Same can be said over here. Between this point here, when we start to break the pattern and the bear market low in October of 2002, bad things happened. Thus, the million-dollar question is, does the present-day market look more like the favorable period in the 1950s and 60s and the favorable period in the 1980s and 90s, or is the present day starting to morph into something more concerning like this or this? Again, we're just talking pattern recognition here, and the answer is relatively simple. Price action, 2011, holding at or near the same monthly moving averages. It holds at or near the same monthly moving averages in 2016. Does it in 2018, the COVID low in 2020, and at the major low in October of 2022 for the S&P 500. As we noted earlier, the NASDAQ doesn't bottom until late December 2022. Same can be said for the Chandé trend meter. This, from 2011 out to the present day, the chart is dated March 18, 2024, looks a lot like this window here, and the trend meter looks a lot like this window here, and the present day pattern, again on March 18, 2024, really doesn't look anything like price action, nor the trend meter in this window, nor in this window. The moral of the story is very, very similar to the moral of the story in April of 2023. Price action and the strength of the long-term trend on March 18, 2024 simply tells us to keep an open mind about much better than expected long-term outcomes while maintaining realistic expectations about 100% normal and to be expected volatility that occurs within the context of all bullish trends. We'll close things out this week with some data from Friday's session and an update on our long-term research project. Kathy's currently in the early stages of 1959, and I'm into 1967. Friday, March 22nd, 2:17 p.m. Eastern Time, the S&P was up 124 points for the week. Thus, it's not surprising that our model scores are still aligning with the text on the top of this page. 5 words on this topic: great job and thank you. 3 months later, we can thankfully say that everything in the January 19th, 2024 video still applies. And circling back to the small cap topic late in the week, this chart is Friday, March 22nd at 3:48 p.m. Eastern Time. It's hard to make the argument that small caps underperforming large cap growth by 1.08% this week is a good reaction to what was interpreted as a favorable Fed meeting. If we go back to that window in November of 2020, you can see that was not the case. Small caps started to outperform large cap growth stocks significantly. As always, we're not rooting for or against small caps here. We're just trading the chart in front of us. If you're familiar with weekly clouds, at the end of the second week of November 2020, and this is the point where you have a firm breakout relative to this consolidation pattern here, IWM divided by SPY. So when you head into the third week of November, you have evidence in hand that says small caps are starting to become attractive, especially on a relative basis. If you compare and contrast the look of the cloud on November 13th, 2020, to the look of the exact same chart using the exact same ratio during Friday's session, 10:21 a.m. Eastern Time, there's no question, if you want small caps to outperform, this looks a lot better than the chart in front of us here, dated March 22nd. And obviously, that's subject to change. In the underperformance of small caps this week, there's almost an infinite number of factors that come into play there. However, post-Fed meeting, one significant contributing factor to small cap underperformance this week is most likely the topic that we've covered in the past, the topic on your screen. The takeaways from this data and the takeaways from this research tell us the topics on the right side of your screen here are still relevant. As noted earlier in the video, it's also important to psychologically understand and respect the topics shown on the left side of your screen. Day by day with realistic expectations about normal volatility. Counter-trend moves and counter-trend moves in leadership, 100% normal and to be expected. And we all know, if we're going to execute well relative to the topics on your screen, it's important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.